I'm excited today to talk to you about something that a lot of our customers have been asking about. So to explain it further, I've brought with me Chris Kozlowski, Chief Financial Officer with Carter Machinery. He's going to talk to us a little bit about how Section 168K works, how it applies to us. And I do want to remind everyone that this webinar is live. So as you have questions, please feel free to put those in the chat. I will be reading those off to Chris and making sure that we get our questions answered. So again, welcome everyone. My name is Kate. I'll be moderating today and I'll hand it off to Chris.
Thanks, Kate. Really appreciate it. And thank you everybody for joining us this afternoon for Carter Machinery's webinar on the Big Beautiful Bill, or Section 168K, and bonus depreciation. Kate does have some administrative items to go over, and then we'll get started with some more detail.
Yep, that's right. So as I mentioned earlier, this webinar is being recorded, but it is live. So as you have a question, please feel free to put it in the chat. I will be monitoring the chat to make sure those questions get answered right here with our resident expert.
Thanks, Kate. So we'll get started here real quickly with a little bit of history on bonus depreciation. This all stems from 2017 and the Tax Cuts and Jobs Act, where 100% bonus depreciation was introduced. And it was started to phase out in 2023. It started to phase out to 2025, where if this big beautiful bill wasn't passed in 2025, there'd be 40% bonus depreciation, but now it's 100%. The big beautiful bill itself, or B3, as I like to call it, it's a little bit of a tongue twister, was an 884-page bill passed by Congress about July 4th. And there's literally one line in this bill that talks about bonus depreciation and amends Section 168K to give us some really good tax benefits. We'll also talk a little bit about Section 179 in this webinar and how there's some confusion about what this bonus depreciation applies to and the interplay between 179 and 168.
Awesome, awesome. So I do see some questions already rolling in. It looks like we're getting questions about, let me sum these up into some themes. What qualifies? Okay, so someone's asking, which of my current or future equipment purchases qualify under the qualifying tangible property rules for 100% bonus depreciation?
Sure, thanks. So thanks for that question. There's really two rules here. One, it has to be business use property, so it cannot be personal use property. And the second, it has to have a 20-year or less lifespan. So when you depreciate property, each of those properties has a depreciable life. If it's 20 years or under, it qualifies.
Okay, and that's anything starting in 2025.
Yeah, so there's a rule called place in service, right? And so this property has to be placed in service after January 19th, 2025. The rule really is it has to be purchased and placed in service after January 19th of this year to qualify for that bonus depreciation.
Okay, okay. I've got another question coming in. Are there any restrictions on used versus new equipment?
Yes, there are some restrictions on used equipment, but really the bill itself says it applies to new property. But the definition of new property also includes used property. So it's a little bit confusing.
So it's new to me.
New to you. Okay. Exactly right. So you can buy used property as long as it's new to you and capitalized in this year or in the taxable year for that tangible personal property for business use. That's
okay.
right.
Okay. And then another question I see coming in. Let me make sure I'm reading this correctly. So do component rebuilds, I'm thinking that's probably a reman or exchange engine or transmission or torque converters, et cetera, qualify for bonus depreciation, or does it have to be a full certified powertrain level or higher?
Yes. Okay. Thanks. Really good question here. This is another one of the confusing areas, as it has to be quote unquote new property, but new property also includes the capitalized portion of a rebuild or a remanufacture of that property. It doesn't have to be a large rebuild. It doesn't have to be a large component exchange or equipment for equipment, but it does have to be new capitalized expenditures. So we won't really get into the details of what's capitalizable versus what's expensable in the current year, but as long as it is capitalizable on your books this year, it qualifies for bonus depreciation.
Okay, awesome. And I think we should probably qualify this by saying, this is great information, but always consult your tax advisor for how the situation applies to you.
Absolutely. I'm sure the folks on this webinar do have CPAs of your own. Please don't hesitate to reach out to them. They should be very well versed in this section.
Okay, awesome. I do see some more questions coming in, and to those of you watching from home, please continue to send these questions, and I see quite a few. The next one I see is, oh, here's a good one. Can I depreciate the entire cost put into my machine rebuild?
Okay, so there are really two parts to this. Carter Machinery does rebuild its own equipment and sells that as used equipment. That entire used equipment purchase would qualify for bonus depreciation. A little bit of a tie into the last question. The portion of that rebuild that is capitalizable cost is eligible for that bonus depreciation.
The portion of the rebuild that's capitalizable cost is eligible.
Yeah, exactly. So if you have a used machine that has 2,000, 3,000 hours on it, you bring it into the shop, have an engine component rebuilt. The cost of that engine rebuild, right? So not necessarily the cost of the equipment itself, but the cost of the rebuild is capitalizable in your books and should be eligible for bonus depreciation.
Okay, awesome, awesome. Okay, more questions coming in there. Are there specific types or threshold, size, weight, cost that disqualify any equipment?
Yeah, so again, going back to the two items that we talked about before for eligibility, look at the depreciable life of the property. It has to be 20 years or less under what's called MACRS, or Modified Accelerated Cost Depreciation, cost recovery system. And that's in the IRS code. It's pretty, it's self-explanatory, but again, ask your CPA. And the second piece that it has to be business use equipment.
Okay, awesome. And then I think there's one more question. Let me get to this one before I take it back to you. Yeah, here's a good one too. Any specific types of equipment that are excluded? Certain vehicles, non-business use, et cetera.
Yeah, so non-business use, we already went there, but really it's real estate, land, buildings. Now, this is probably past the scope of this webinar, but there are types of real estate, quote unquote, real estate, where it's not affixed to the property that could also qualify for bonus depreciation. But as a general rule, real estate and land would not qualify for bonus depreciation.
Okay, all right. I'll pause with the questions. I see more chat boxes coming in, and let you tell us a little bit more.
Yeah, no, I appreciate it. So, I mean, those questions are great. I've gone into a little bit about kind of what the eligibility requirements are for this program through those questions, but really let's talk about some of the benefits here. Right now, you place equipment in service, which place in service means, especially for the equipment you can see behind us, moving dirt. So if you buy a machine, have it delivered to start moving dirt, you actually place that unit in service, which qualifies it for that bonus depreciation. And again, it has to be 20 years or less of a depreciable life on that property. And once you identify which property that is, you can depreciate that in one fell swoop. So if you buy an excavator this year for $500,000, place it in service, move a little bit of dirt in November or December, you can depreciate that $500,000 or take that as a tax write-off on your tax return. Going into a little bit of what people are used to, a lot of folks who've been in the business a long time know what Section 179 is. And so 179 bonus depreciation has a lot to do with expensing items that are normally depreciable. There are two problems with Section 179, especially for some of our larger customers and some of the larger equipment operators out there. One is that there's a cap, right? And so for 2025, there's a $2.5 million cap. If you spend more than $2.5 million on equipment, that equipment is no longer eligible for $2.5 million of depreciation. You're capped at $2.5 million. The other limitation of Section 79 is that it can only apply to your taxable income. So even if you do have $2.5 million of eligible equipment that you can expense under 179, if you have $150,000 of taxable income, you can only use $150,000 of deduction.
So there's no way that the government pays you back.
No, there's no way the government pays you back. And there's a nuance here too in 168. The government will not pay you back under 168K, but there's another benefit that we'll talk about. So under 168K, there is no limitation. You could buy $50 million worth of equipment and you have a $50 million tax write-off. The other part about 168K is that it also creates a capital loss carry forward. Now, what that means is you have the same situation and you have $150,000 of taxable income in 2025, you can take the excess that you're not able to deduct under 179 and use it as a loss carry forward to offset income in future years as well. So those are two really big benefits to our customers and to equipment operators out there for using 168K instead of 179.
Okay, so what I heard you say is take advantage of the opportunity sooner rather than later.
Correct.
Okay.
Yeah, take the advantage of it now. One of the things I like to say is if you don't do it now, if you do it in 2026, you're basically lending Uncle Sam money for another year. So the worst situation from my perspective is if you buy a piece of equipment on January 1st, You don't get that tax benefit until 2027 when you
Mm.
report your 2026 taxes.
Yeah.
If you buy that equipment in December 31st, place it in service, move some dirt, if you will, you get that tax benefit immediately.
Okay, now it's starting to make sense why we're getting so many customers asking about this as we get into the second half of the year,
Right.
because they want to take advantage. Okay.
Right.
Okay.
Now, with all those advantages, and trust me, there are a lot of advantages here to bonus depreciation, there are some detriments. One of the detriments that some customers need to be aware of is that when you go to sell this equipment, right, you have to take all of that income when you sell that equipment all as ordinary income and not capital gain. So this is not much different from your normal depreciation. So if you have a piece of equipment that has a 5-year life and you sell it in year 3, right? So you're depreciating 20% a year for 5 years. You've depreciated 40% of it. You'll take that gain, the delta between what your book value is and what the sales price is, and that's ordinary income. Now, with bonus depreciation, your basis in that for tax purposes will be 0. So you'll depreciate that entire amount of that excavator in year 1. It'll be 0. And no matter what you sell that piece of equipment for, it is ordinary income when you sell it. Now, this is also a good thing for folks that plan to have this equipment for longer than its depreciable life, because there's no difference between a modified accelerated cost recovery system depreciation or a bonus depreciation scenario.
Okay.
That's a lot of tax words.
That is a lot of tax words, but I think the bottom line is part of the B3, as you call it, the big beautiful bill, is the engine being the section 168K, making this 100% bonus depreciation possible.
Yeah, exactly. And again, there's a lot of confusion out there about both what this applies to and which section you can use. There is an interplay between section 179 and 168K, where you can use some 179 and the remainder 168K. But if you're not trying to limit your capital loss carry forwards, if you're not trying to limit your losses, what you should really do is use 168K in full. Another issue with 168K, although it's not a negative issue, is that there is no elect in or elect out, as in per asset with 179. You can't elect out of bonus depreciation in whole, right? So it's either you take bonus depreciation on all your property or you don't.
Okay, all right, I'm gonna let that digest a little bit here. I do have a bunch of questions rolling in if you got time for some more questions. Okay, perfect. Let me just see if I can sum some of these up. So you mentioned placed in service or activated. So what constitutes placed in service in my business? Like, is it when I take delivery, when I pay for it, ready to use?
Yeah, so there's a lot of different ways that CPAs look at this. One is if it's delivered and invoiced, some CPAs take the position that that is eligible for bonus depreciation. What I mentioned before, and moving dirt is the example that I used. When you actually put it to work is the most conservative reading of the tax code. So when you put that machine to work, it is absolutely placed in service. But also, there could be a reading where if it's ready to be placed in service, if it's on the lot, ready to work, you have an invoice for it, and you're ready to use it, that can be placed in service. So again, can't emphasize this enough. Talk to your own CPA before making those type of calls.
Okay. I think this one's probably in the same vein as the first question that came in. If I wait until later in the year or even next year, do I lose out on bonus depreciation or other benefits?
No, you don't necessarily lose out on those benefits. Those benefits are delayed. So you will have a delay in those benefits if you wait to 26 and 27. Now, one of the items that's interesting here is that this bonus depreciation has been made permanent, whereas before we were subject to a phase out, and now this has been made permanent. But permanent only means that it's permanent until Congress changes their minds, or they have another bill that goes across with a new administration. But as of right now, bonus depreciation is here and it's here to stay.
Okay, and I think there's a lot of people asking the same kinds of questions, right? Is there any deadline for when equipment must be in service to get the full benefit?
Yeah, no, there's no deadline necessarily, but it has to be for a certain tax year. You have to place it in service for that tax year. And right now, there's no hard and fast deadline. But again, as we all know, laws change very quickly and very often, particularly with new administrations coming online. So it is better to pull those purchases forward if you can while these rules are in place.
Okay, all right. And I see a flurry of questions coming in. Oh, here's a good one. This one's about financing. So if I finance or lease, how does that affect my ability to take the deductions?
Yeah, great question. So I'll hit that lease piece in a bit, but if you finance it, it doesn't matter. So as long as it's on your books And as long as you have a capitalized cost on your balance sheet, no matter whether you pay cash or you finance, that does not matter. When you lease property, there's a little bit of nuance with lease. If it's what's called a capital lease, so if you're financing this with a capital lease, there is an avenue to get bonus depreciation on that property. If it's an operating lease, unfortunately, there's no bonus depreciation for operating lease property.
Okay. Okay.
One other item, Kate, that I'll mention is that we do have a lot of customers who have what's called an RPO or a rental purchase option. If you are renting the piece of equipment and then decide to purchase it, that purchase becomes new capitalized equipment for you on your books. So what we call conversions, right? So from a rental to a purchase, if you convert those machines to a purchase, those items are also eligible for bonus depreciation.
And the date that triggers it is the date that you do the RPO,
Correct.
not the date you started renting it.
Correct. Exactly right. It's the date that you purchase and place that equipment in service as your piece of equipment.
Okay. Okay. Interesting. Okay. I think you might have already hit on this, but this question just came in. Are there special rules for leased equipment versus owned equipment?
Yeah, we really just mentioned that. Just be careful in terms of what's a capital lease and what's an operating lease, and make sure that your accountant agrees with you, what capitalized costs can be depreciated here.
Okay, and I think we are scratching the itch here on these financing and leasing questions, because now we're getting more of them. What are the pros and cons, tax and cash flow of buying outright versus financing under this new law?
Yeah, so it really depends on each customer, each operator's use of this equipment, right? So what we like to do, and in my former life, what I used to do is look at what the net benefit would be. So if you do an analysis of if you plan on using this equipment for a long period of time, you can take all the benefits of ownership, the tax benefits of ownership, versus what lease payments you would expect to pay for that over the lifetime of that equipment, and make a call. Looking at that net cost is really helpful, but this is a new variable to introduce into that analysis, which is, what are the benefits to me of my tax liability? What are the benefits of the bonus depreciation to this process, to maybe make it more beneficial for me to own this piece of equipment rather than lease it?
Okay, and the next question, I think you might have already hit on this, but let me phrase it differently. Are there caps or restrictions? Example, if I have a lot of debt or high leverage?
No, this applies to all equipment, whether or not you have high leverage. If you're highly levered, contractor, it does not matter. You can still utilize this bonus depreciation.
Okay.
One of the things that I'll mention, maybe as a corollary to that, is that if you do not have a lot of taxable income, this is not what's called a refundable tax deduction or tax credit. The IRS will not stroke you a check, for what you have a loss for, but it does offset income now and in the future with those carry forwards.
Okay. Okay. Can this be leveraged in conjunction with financing programs? Someone's asking about 0% for 36 months on the CAT card.
Yeah. Yes. So as long as the equipment remains on your books, like again, we talked about operating lease financing or capital lease financing, as long as the item is on your books, you have a liability to pay for that equipment, and it's on your books, you can use those financing programs in conjunction with this bonus depreciation. Absolutely.
Okay. All right. It's a lot of information.
It's a lot of information.
But
it's a big bill.
It's a big bill, but I can see that there's a lot more questions coming in. So this one looks like a question around maybe section 179 versus 168. So here's a question. Given my expected equipment purchases, is it better to lean on section 179 or bonus depreciation, or both?
So you can use both. I would say if you were to choose one or the other, most contractors, most equipment operators will use bonus depreciation rather than 179.
Okay.
Again, kind of going back to what I was saying before, so 179 is an asset by asset allocation versus whether you want to expense that equipment or not. Bonus depreciation applies to all of your capitalized assets, all of your less than 20-year depreciable property assets.
These are some good questions. I'm going to try to stump you.
Sure.
Let's see. The next one is: are there limits or phase outs on section 179? That I should know about for my size of business, how much equipment I buy?
Yes, there are phase outs and limitations, particularly on the amount of capital that you outlay for those pieces of equipment for 179. I'm going to keep going back to section 168K. I mean, this is really a wonderful opportunity. There are no limitations. There are no income limitations like there are in 179. It really is just across the board a great tax benefit for equipment operators.
Okay. All right. The next question that's coming through, how do state tax rules interact?
Yeah.
Do they follow federal business depreciation, or are they more restrictive?
It depends on what state you're in.
Okay.
Virginia, where we're sitting right now, has different rules for bonus depreciation. So there could be a scenario where your Virginia tax liability will actually be higher than your federal tax liability, given the bonus depreciation that you do use.
Okay.
So again, it's very state specific, and that's a question for your CPA.
All right, I see more questions flying in here. Okay. Do state tax incentives exist or change in light of this that may overlay or compete with the federal ones?
Yeah, so as of right now, a lot of states are reacting to these laws. As you saw in 2017, where there was what's called a SALT tax cap for certain states and high income tax states. There are some ways to get around some of those items. So it's still a fairly new law, given that it was passed in July. So we will see some states react to it.
Okay, all right. Okay, I see a pause in the questions. I'm gonna give you a breather from grilling you here. Sure. Tell us a little bit more.
Yeah, and really that's from a technical standpoint, there's a lot to be said there. I think we've gone into a lot of the technical items that we wanted to cover. But again, you just really want to make sure that we underscore the benefits of this. It's an immediate tax savings when you put that property in service. That it allows you to utilize capital in a different way. So if you're not using your capital to pay Uncle Sam, you can hire new employees, you can reinvest in equipment, you can reinvest in your business. And this is really supposed to be an economic growth driver and allows businesses to use their capital in ways other than paying taxes with it.
If you take advantage of it.
If you take advantage of it, yeah. Then that's exactly right. Again, it applies across the board, new, used, rebuilt equipment. Just make sure that you understand the rules in terms of capitalizing what type of equipment it is. And really, it makes sense to do it now. It makes sense to do it when you're ready to buy that equipment. It helps you pull the trigger in terms of whether you're going to buy that equipment in 25 or 26, or even 26 and 27. Okay. If you want to pull that equipment purchase forward, that tax benefit and the time value of that money that you will save with the IRS, becomes more important.
Okay. All right. And just a reminder, because I see a lot of questions coming in, if we don't get to them live today, we will be following up with anyone who sends a question over. There's a bunch coming through, but I know we are trying to keep it short. Sure. So let me just get a couple more questions for you. Is that okay? Absolutely. Okay, let's see. I'm looking at my screen here. So this one, how will resale or disposition of equipment interact with depreciation or recapture? That's probably a pretty good question.
Yeah. Great question. Again, I mean, we talked about when you sell the equipment, you will recapture that depreciation in the form of ordinary income rather than capital gain. In terms of ordinary income, that's typically more expensive than capital gain tax, depending on your classification and what income bracket you're in. But just know that when you do depreciate that equipment faster and you sell it fast, you could have more ordinary income on the disposition of that property. However, it doesn't sound as bad as it sounds. It's not actually as bad as it sounds. As long as you are doing that in a normal course of business, you're really just offsetting the depreciation that you took earlier. So really, you're pulling forward that tax benefit.
Okay. Another question around sort of resale and additional costs to be aware of. Are there caps or phase outs based on how much total equipment you buy? I know that we talked about.
We covered that. Yeah. So really just 179, 168K there on that.
Okay, perfect. Another one coming in. Any other hidden costs, example, insurance, maintenance, registration that may be impacted by accelerated depreciation?
Not particularly. Again, it really depends on your particular circumstance. And again, I would just make sure another vote for CPAs here. Just make sure you're doing this correctly. And hidden costs could be an audit, so you don't want to get there. So read it conservatively. However, it is pretty wide sweeping. So we are very comfortable in using this type of this tax law to benefit our company as well as our customers.
Okay, awesome. Still see lots of questions coming in. As a reminder, if we don't get to your question today, we will be answering it in a follow-up. This one looks like maybe a rental specific question. Okay, if a customer rents for the short term but is considering a purchase, what's the potential financial impact of buying new or used equipment under bonus depreciation?
Yeah, no, another great question, and I'll go back to the net benefit of this law. If you do the analysis and you're planning on using this equipment for the long term, and you have jobs that can cover the use of this equipment, it does make sense typically to buy this equipment rather than rent it, especially with these tax benefits. So again, calculate that net benefit, the overall kind of cost of use of that equipment during its lifetime, and make that call on a case-by-case basis.
Okay. Here's another question that's kind of similar to that. This gentleman says, many of the machines we rent are also available for purchase, either new or used. How does bonus depreciation make ownership more attractive for customers who've primarily rented in the past?
Yeah, and again, it just tips that net benefit scale, right?
Yeah.
So when you're adding that extra variable of the tax benefits to this process, for the most part, in a lot of circumstances, it will tip that scale toward buying a piece of new equipment if you can take those tax benefits and take them now.
Okay.
But again, it is really circumstantial and what your business looks like, and making sure that if you have income to offset, it can really help from a cash flow basis as well when you don't have to stroke that check to the government.
Okay, good to know. All right, and let's see, I have one, let me do one more question, then we'll wrap it up. Is that okay with you? Okay. The last one is, what advice would you give a customer who's on the fence between extending a rental or pulling the trigger on ownership? And is there still time in this calendar year to do a rebuild if you wanted to take advantage in 2025?
Yeah, I mean, so we still have a full quarter left. There is some time to do some rebuilds. Now, if you're bringing in a D11 and it needs a ton of work, maybe not. But there are a lot of component rebuilds we could do, a lot of smaller rebuilds that we could do that could get through the shop by December and back in your operating fleet by the end of December. Again, just look at this tax benefit, look at what it does to your overall situation, and just make sure that you understand the benefit that you're getting from this tax.
Okay, awesome, awesome. Well, I wanted to keep it short and sweet. I appreciate your time today so much, Chris.
Thanks,
Thank you
Kate.
very much. Again, my name is Kate Fraley, coming to you from Carter Machinery, right here in the Mid-Atlantic. We service, gosh, Virginia, Maryland, DC, some of West Virginia, Delaware. Yeah, so we've got a lot of customers who can take advantage of this. Again, hopefully this information has been helpful to you. Speak to your CPA if you've got a chance to take advantage of it in this tax year. Keep your eye out from us. We'll be sending some follow-up communications. And once again, thank you for your time today, and thank you, Chris.
Thank you, and thank you all for joining us.